So if we're bullish, I teach and I have taught on this YouTube channel multiple times. My Power 3 concept is if we're bullish, we're going to be looking for the opening price at midnight. It's going to drop down, create the low of the day. It's forming it at 9:10 New York local time. It rallies up, shift in market structure. So it doesn't give me my objective, but it gives me these clues here. Now, the whole time I'm not tweeting to you. I'm studying price. I'm working with my son, and I'm measuring all these things. Because last word I gave on Twitter was I was looking for 40.70. No problem. No trade either. But I mentioned that there was no setup. There's nothing going on. And then the market rallies up. Okay. What I was looking for, it didn't reach it, and it didn't give me a setup. Did I lose any money? Did I take any kind of a painful ego twist to my arm? No. Was I wrong in the public eye? Well, some of you may think that because it didn't go to 40.70. But if I'm looking for something to deliver and it doesn't give me a setup, last time I checked, if you don't put a trade on, did you lose? No. If you put some skin in the race and you tell the public what you think is going to happen and it doesn't happen, do you lose? Well, it depends on what your audience's mentality is. If they're looking for face value, yeah, I was wrong about 40.70. You hear that? ICT didn't get something he thought. 40.70 didn't print. No problem. I don't need to be right. The S&T divergence here in the higher low versus the lower low in NASDAQ comparably. And then we have that shift in market structure. We trade back down into the 15-minute fair value gap here, and then we rally once more. Once I saw that, then I'm good to go. I'm waiting for the afternoon setup. But now watch what's happening. The market rallies up, falls short of 41.40. That was another level I gave in that little stinger video on my Twitter feed. So I'm going to count you to go over there and check that out. And then it drops down into the fair value gap, starts to rally, but look what it does. It leaves these smooth relative equal highs. And then does what? Drops once more below that short-term low. Now, think about what I've given you in your notes as it relates to trading the PM or afternoon session. If you're bullish, generally what will happen is the market has ran higher in the morning, then it consolidates into the lunch hour. Then after the lunch hour, it'll drop down and sweep the sell stops or below some short-term low or the lows made in lunch. Okay? Now watch what this does here. It creates a low ahead of the lunch hour at noon. Then it drops down into the fair value gap. Is that not doing what I gave you in terms of the rules of what liquidity is doing in the afternoon, post New York lunch when we're bullish? Yes. What's different? It's not consolidating. You see that? Is this a consolidation? No, it's a retracement. So if you can identify an area where it's likely to retrace, and some of you asked on the Twitter feed, why am I measuring from here to get this versus this here to here? Well, you have to ring in what I'm trying to do. I'm trading the daily range. I'm trying to get the majority or the lion's portion of the daily range. So because I'm doing that, I'm factoring in that midnight opening price. So we've went above it here and once more. So I'm not expecting it to go back down below here again. So to refer to this low now, again, is pointless. I'm going to use this one here for market structure. So market structure swing low here to swing high, that's my dealing range. So that's why I outlined that one here. Okay. And I gave you that small little rectangle up here, drawing my attention in the video here to go back to what I mentioned moments ago. That's an old imbalance, and it may stall here. It may fail here. It may just consolidate and then run for previous day's high, on Wednesday. So I want to take half my trade off, which is basically what you saw me do. But anyway, it's taking out that short-term low on a retracement. But if it was consolidating into lunch, I would look for the swing lows during the lunch hour and then wait for it to drop down, sweep them like it's doing here, and then rally. But because this is a retracement going into lunch, that to me, it signals that they're going to work through lunch. What does that mean? Years ago, when we were on the floor only, open outcry, sometimes the floor traders would know that the market was in a hurry. It's a fast market. So they're not going off the floor. They're going to stay busy on the floor, and they're going to be trading. So I learned this from actual floor traders, so I'm not making it up. I'm not just giving you some kind of garbage made up or some contrived nonsense. It's based on what they used to do, and that same mentality has been transferred into electronic trading. So the algorithm does that same thing here. During the lunch hour, if it's a fast market, it's retracing back down in to a random fair value gap. It creates a short-term low, and then it runs the only short-term low that's there from here to here. This is too narrow. We don't want that. It's already moved too much. And it's going into that hour ahead of lunchtime, noon to 1, New York local time. So I want to see it retrace back down into a discount. How is that done? From that low to high. So the algorithm reprices to a discount once it gets to here. Then it does what? Creates that short-term low, rallies a little bit, leaves smooth highs in here. So what is that? They think that is resistance. So anyone that's short, they trail their stop loss here. And then drops one more time right below that short-term low. What's below that short-term low? I have already told you here. Sell stops. So I'm thinking, like smart money, this is going to go higher in the afternoon. I didn't take anything in here in the morning. And I was not correct in where I thought it could reach for, which is 40.70. If it would have went to 40.70, you know what I would have done? Said, there's your 40.70. And you would have asked, did you take a trade? Or the cynics would have said, but you didn't take a trade. That's not what I'm trying to teach you. I'm not trying to teach you entries. I'm teaching you the logic on how to read the markets that way. Once you get this skill set down, the entries are the easiest thing to do. That's the easiest thing to do. But you have to know how to read the market and also tell when the market's turning. And if it's turning, where's it going to go? And if it's going to go higher, where will setups form? I showed you that today. Right on Twitter. Right there in front of everybody. Now, the market drops down into the sell stops here, and it's inside that fair value gap. And it's happening in the lunch hour. Now, I had things I had to take care of, and I was going to be away from the screens as I was. And I didn't think I'd be back before 2 o'clock. But I was managing that trade from my cell phone. And you can see that cell phone trade management in the short little vignette. You can see the stops being raised, and I'm taking partials along the way, the whole business. But as it's going up into this area here, I'm taking some of the contracts off, and I'm raising the stop loss up because I don't want it to come back down into that fair value gap again, because what it's done is once, twice, it should never come back down that again. If it does, I'm wrong, and I don't want to be a part of that trade. If I'm in a position that's still open or have a partial open from the original position after partials have been taken, then I'm going to kill the trade and I'll move to the sidelines. But the main thing I want you to understand about this is I'm not trading the model that I'm teaching on YouTube. And you're probably going to say, well, why don't you just trade the model, Michael? Why don't you just teach us how to use the model? I am. When the model speaks, I'm going to show you. But I'm also teaching you how you still learn to read price when the model isn't giving you a setup. Because every single market isn't going to give you that model's entry, setup, and framework every single day, every single session. And because I'm the author of these concepts, I don't have a limitation to just that one. So is it beneficial for you to have me say nothing when the model says nothing? Or is it beneficial for me to teach you how to read price action, how to get in sync and learn how to change gears when the market shows you it's time to change gears?